The next model of economic growth we are going to study will be based on the circular flow diagram. Now, the circular flow diagram presented in the book is a little bit complicated, so I took this from another book of Principles of Economics, and we're going to start studying this simple version, and then we are going to generalize it to the more complicated version. The circular flow diagram, a visual model of the economy, shows how dollars flow through markets among households and firms. Well, intuitively, you know that money keeps changing hands. Think about a dollar bill that you have in your wallet. It is sort of filthy, probably by now. Why? Because it keeps changing hands. Now think about it. You can use the dollar bill to buy, candy. Then the owner of the candy store used that dollar bill and many other dollar bills to pay wages, so it's gonna end up in somebody's pocket, let's say the person that worked there. So the dollar bill already changed hands twice in this example. It started in your hand, then it was in the wallet of the owner of the candy store. Then he or she used that dollar bill to pay wages to the person that works in the candy store. So that person used that dollar bill to pay, something in the Walmart, and so on. So you get my point. Money keeps changing hands. It is like a circular flow. One day that dollar bill may end up back to you. Chances are very small, but it is possible. So this model is about that. It's trying to explain the flow of money in an economy. We are going to have two types of actors in this model, the households and the firms. And you're going to have two markets, the market for goods and services and the market for factors of production. The market for goods and services is whatever you buy, some good for yourself, or a t-shirt, some shoes, or a haircut. We also have the market for factors of production. What are factors of production? The resources the economy uses to produce goods and services, including labor, land, and capital. For instance, we are all born with the factor of production, labor. We sell that to the firms. We go to the job market, we look for a job, we sell our labor, and in return we get wages. Now, some people have other factors of production, for instance, land. If you inherit land, you may rent it to a firm so you can set up a factory over there or can set up a farm over there. Some people inherit or have capital like buildings, machines, etc. They also can be used in production. So factors of production are also purchased and are also sold in the same way that, so here we are. We have the households and you have the firms. The households, they own the factors of production. What do you do with your factor of production? You sell them or you rent them to firms, and in return you get income. Now the households, they also buy and consume goods and services. What about the firms? The firms hire factors of production and they use them to produce goods and services. And then they sell those goods and services. Now notice that both these actors, these types of actors, they are interacting with each other. Firms buy factors of production. Households own and sell, so they can sell or rent factors of production. Now households buy and consume goods which are made and sold by the firms. So they are interacting with each other. This interaction is happening in two markets. Households own factors of production, so they go to the market for factors of production, like the job market for instance, and sell their factors of production. The firms buy them. Now you don't do it for free, you don't work for free. So in return, firms pay wages, rents, and profits. And here we go, the dollar bill goes from the firm to the household. Okay, but there's another market. The household use this income, this wage, or this rent that it got from the firms in the markets for factors of production, and it's going to spend it in the market for goods and services, and that will be the revenue of the firm. And the firm will sell the goods to the households. The income, the dollar bill, is being represented by the green arrows, so it keeps flowing in the economy, flowing, flowing, flowing. The green arrows are the flows of income. The red arrows are the flows of goods. These goods can be final goods or it can be factors of production. So here are factors of production and goods and services in the red arrows. Here are the flows of income in the green arrows. So the whole point is money keeps flowing, keeps changing hands here. Now the one in the book is a little bit more complicated. It has households and businesses. Household go to the commodity market or the market for goods and services, and in return it pays money to the commodity market and it receives goods and services. Here is the resource market. That's what in the other book it was the market for factors of production. So households sell labor, capital, land, entrepreneurship to the businesses, and in returns it receives wage, interest, rent, and profit. So this is the green arrow here, basically, where income keeps flowing and flowing and flowing. Now there is another market here, the local financial sector. That's because in the easiest version of the model there are no savings and investments, but part of the income of the household is not spent on goods and services. Sometimes they save it. So you go ahead, you don't spend all your paycheck, you save it, but you don't keep under your mattress, you deposit it in a bank. And what does the bank do with your money? They lend it to business so businesses can expand. So they lend it to business so business can invest. So part of the flow of money sometimes goes through this market here, but it's still flowing. Dollar bill may start here, goes to the households here, then the dollar bill may end up in the bank as savings, but it's back to the business as money for investments, as a loan for investments. So you have the flow of money going on. The most important thing for our purposes, though, is the following. In this more sophisticated version of the model, sometimes there is an inflow of money from outside of the region, and sometimes there is an outflow of money to outside of the region. For instance, when businesses, if they sell a final good to somebody that lives outside of the region you are thinking about, let's say a county, to somebody outside of the county, that's going to have an inflow of money into this circular flow. So what happened is, if there was $100 flowing here over and over again, now there's going to be $120 flowing here over and over again. Whenever there's an inflow of money from the outside of the country, it's like the extent of the circular flow diagram grows, the overall income grows. Now sometimes there's an outflow of money, shrinking the flow of money in the region. For instance, when the businesses, when they buy inputs from a non-resident, that's the money will leave the circular flow to go to another circular flow of another region. Well, we're in households. If they work, for instance, in another county, they will bring their paychecks here, so there is an inflow of money going on. However, if a household goes to a store in another county, there's going to be an outflow of money. Same thing with the financial sector. The bank can lend money to a firm outside of the region, or it can receive deposits from a resident of another region. Then there's going to be an inflow of money. The point is, the size of the economy which you want to grow, that's your purpose as an economic developer, the size of the economy will grow depending if you have more inflows or more outflows of money from the circular flow diagram. While exports, imports, and other monetary exchanges are important for nations, they are even more important for local economies because they are smaller. If you are small, it is much easier to buy and sell from another region. Normally, the smaller the region, the more open the economy is, and the more important money inflows and outflows are. If your region is large enough, you can buy and sell all inside the region. But if you live in the middle of nowhere, you're going to have to go outside the county or the region to buy what you need, and you're probably going to have a job outside of the county as well. So the smaller the region, the more imports and the more exports. And what that means is the more money inflows and outflows. The difference between the size of the monetary inflows and outflows is critical to the local economic growth. Monetary inflows can cause the entire volume of money circulating within an area to increase, increasing incomes and employment. Again, there's a volume of money circulating. You want monetary inflows so the volume of the money circulating goes up. Monetary outflows shrink an area's circular flow and consequently decrease local income and employment. When do you have an equilibrium then? We have an equilibrium when monetary outflows equal monetary inflows. That's when the community income level will remain constant. But our goal here will be to increase the volume or the size of the economy. More about that next.